And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. Welcome to the Hump Day edition of The Real Investment Show. That's right, it's Wednesday, and that also means that Danny Ratliff joins me this morning. We're going to talk about should you borrow from your 401k plan and some other hot topics this morning. So a lot of stuff to get into with him once he gets here. But, yesterday markets kind of rallied here a little bit again and did okay, holding above that 50-day moving average. So, we'll talk about that here in just a moment. This morning, futures are basically flat. And again, just kind of as I talked about the other day, we've had the longest stretch of win streaks for the S&P 500, 7 days. That's the longest since 2021, believe it or not. So it's been a very sharp rally. So expect a bit of a kind of consolidation here. Economic data is still going to be kind of ruling the roost here as we get through end of the year. Certainly seeing some weakness, in some of that data just as of late. Bank lending standards continue to be pretty tight. Credit card delinquencies now on the rise in both auto loans as well as credit cards. Now, they're not at high levels yet. Now, they're heading that way. But at the moment, they are certainly increasing, and that's something to, kind of worth paying attention to. That's that kind of pre-recessionary data that we've been talking about. I've kind of mentioned here on the show that, going out to eat has gotten very expensive. Basically doing anything has become, extremely expensive. And, for people that are already kind of struggling to make ends meet, well, that becomes, a bigger challenge when prices go up, but incomes don't keep up with that. So we're seeing continued increases in credit card spending, credit card debt. Now we're starting to see the result of that, which is now delinquencies. I can't make the minimum payment because interest rates on credit cards are now at all-time highs. So again, it's required that minimum payment is going up, which is weighing on consumers' ability to consume, in that bottom kind of 90% of the economy. Now, if you're in the top 10% of income earners, probably not worrying a whole lot. But still doesn't mean that you don't notice that things are getting really expensive and have remained that way. But outside of that, we are starting to see the impact of this kind of economic weight that is occurring from that. And we're seeing slower demand in areas of the economy where you would expect things to certainly kind of show up, kind of on that front. And as we talked about before, the dollar plays an important role in this, as the dollar is a function of imports and exports. So if the dollar gets more expensive, that makes the cost of buying things from overseas more expensive. And of course, we've had, this very strong rise in the dollar. Now, this is interesting, of course, and we were talking about this yesterday during our investment policy committee. We had this huge decline in the dollar starting in about late 2022 and into 2023. We had this big decline. And this is where all the angst was about de-dollarization and nobody wants the dollar. And, we told you then to be very careful with that narrative because that's not the case at all, considering that the dollar still makes up about 70% of the world's transactions. And since then, of course, this was kind of, this last little fall off here in the dollar was that moment of that whole de-dollarization scare. And if you go to our website and just type in de-dollarization in the search bar, you'll get lots of articles on this and why that was not the case. Since then, it's been a very strong rally in the dollar. We are starting to see a little bit of weakness here, not surprising. Dollar's been on a sell signal from a very elevated level. Could see the dollar pull back here a bit more to around 104 on the index. Now, that's going to weigh on other areas of the economy as well. And, one of those is oil prices. And we've talked about this previously, is that, oil is a byproduct of economic activity. And so and after we had this very strong rise in oil prices again back over here, remember these were the conversations that we were hearing. He's like, oil's going to $150 a barrel. We're like, no, that's probably not the case. And since then, we've gone from about $96 a barrel back down to $76 a barrel as of yesterday. This is kind of that normal kind of symmetric, outcome of what's happening within the economy. We're seeing slower economic activity. We're seeing slower demand in certain areas. That is ultimately going to weigh on oil prices, particularly as we move into the end of the year. So, again, the point is always, and we talked about this yesterday at length, is be careful with narratives. Narratives will get you into trouble more often than not. Back around this peak in September, October, we talked about reducing energy exposure and taking advantage of that run up in oil prices because it wasn't sustainable. That's been a good play to be. Let's talk a little bit about the markets, though. Here's what you need to know before the bell this morning. Yesterday, as I said, the market rallied and stayed above that 50-day moving average. We tested it, bounced off of it. We're now currently kind of trapped between the 50-day and the 100-day moving average. So again, there's some risk to the upside here at the moment. We've gone very far, very quickly. We've gotten overbought on a short-term basis. Still on a buy signal from a very depressed level. So again, there's probably more upside to go here in the markets, at least over the course of the next couple of weeks. But heading into next week, we are now getting to that pre-Thanksgiving kind of period, which tends to be a little bit weaker for the market. So expect this market to kind of consolidate here, maybe pull back a bit. Wouldn't be surprising. We could even potentially take out the 50-day moving average because we're sitting right on top of it right now. But as long as we hold above this 200-day moving average and the 20-day, there's going to be some really good support there. Now, post-Thanksgiving, now we'll talk about kind of how this is going to play out over the course of the next month or so. So expect a little bit of weakness here maybe over the course of the next couple of weeks heading into Thanksgiving. Post-Thanksgiving, markets tend to do better as we head into December. So as we get into December, wouldn't be surprising here to see the markets rally a bit. Markets always rally into my wife's birthday on the 1st of December. It's just the markets just, honor her that way. But now, once we get into the first couple of weeks of December, mutual funds have to make their distributions. And that's where they have to distribute their capital gains, interest, and dividends for the year. We talked a little bit about this yesterday. So kind of expect some typical kind of seasonal weakness in the first couple of weeks of December. Then as we start to move into the end of December and heading into the beginning of 2024, that's where you get your traditional kind of Santa Claus rally. And that's where we're going to kind of probably end the year. So again, kind of finishing the year somewhere around 4,500 would not be surprising. Now again, whether we get this exact price action or not, who knows? But that's normally kind of how the seasonal tendencies work this time of the year because there's some pressures on the market itself because of distributions in the first couple of weeks of December. And then you've got all those mutual funds that have to rebalance their portfolio going into the end of the year, do window dressing to make sure they have all the right stocks and the right balances on their portfolio. So that's why you always kind of typically get that end of the year push. Then, of course, the first 5 days of January, you get a lot of positions put on the table. You have end-of-the-year contributions that are getting, for IRAs and SEPs and those type of things, all getting put, kind of put on the books in January. So that's why the first 5 days of January tend to be statistically stronger days of the year. Now, once we get past that, I really don't have any idea kind of how the market's going to work because of so many other pressures, economically speaking, that are laying out there right now. But again, the course of the markets over the next, couple of weeks to the next month or so is most likely going to be somewhere within this range. Again, there's enough buying power that's sitting out there from buybacks to basically just investors wanting to be in the markets, and then a lot of performance chasing by professional managers to kind of play catch up with the market through the end of the year, that we should see support here for the markets. But again, we've had a very big run very quickly. Take some profits, rebalance some risk. Don't get overly negative right now as the market seasonality is still working in your favor. That's what you need to know before the bell this morning. When we come back, we'll pick up with Danny Ratliff and talk about why or should you borrow against your 401k plan. We'll talk about that next, right here on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show. Or just click on the show links at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show today. This morning, it's Wednesday, getting ready to head into Thanksgiving holidays right around the corner. Monday, Veterans Day. So remember the difference between Memorial Day and Veterans Day. Very important, right? You'd be surprised how many people don't know this. Memorial Day, we celebrate the fallen. Veterans Day, we celebrate and honor our living veterans. So that's what's called Veterans Day. So you see a veteran next Monday, shake their hand, thank them for their service and their sacrifices. So a couple of things, as we kind of look forward, the economy's getting tougher and, people are having a tougher time making ends meet. As I was talking about a minute ago, credit card, debt is on the rise. Credit card interest payments are becoming a bigger chunk. We're seeing now credit card delinquencies going up. And, when you get under financial stress, this is where people start kind of looking for, sources of capital to try to make ends meet or, to do whatever they want to do. And one of those has been turning to their 401k plan to take out a loan from their 401k plan. And, the question is it a good idea to do that? People will tell you is like, oh, well, I can borrow interest free from myself, or it's a very low rate of interest and I'm paying myself back. And there's lots of support for borrowing against your 401k plan. But is it a good idea and should you? And Danny's a big proponent of taking everything out of his 401k and spending it on, gerbils and things like that. So
gerbils? That's the best you could come up with?
Troll dolls.
Okay.
Okay, Richard.
I was confused. I thought he was here, maybe. Sorry, Rich. Love you, man.
Yeah. Anyway, just joking. But Danny, this is something we see in times of stress. A lot of people kind of turn to borrowing against their 401k plans, and what do you? Let me, before I interject my opinion on it, what do you think about it?
Well, maybe let's talk about a little bit about how we got here, right? I mean, 401ks. There's a lot of options for leakage within retirement plans. There's a lot of ways that we can take funds out. We are not proponents of taking funds out of retirement plans. And the reason being is that we are basically, you kind of bankrupt your future when we start taking those funds for needs today versus saving for tomorrow. And, number one, you just mentioned it, credit card debt, all-time highs.
Right.
New report just came out. New York Fed said, $1.08 trillion in credit card debt. We are now also seeing a rise in delinquencies, people not paying their credit card balances. And guess what? Guess who's the biggest proponent right now? Actually, all demographics are struggling at the moment with this. But who's number one? millennials aged 30 to 39 are having the hardest time paying back credit cards, making their payments. And why is that? Student loan debt.
Right.
Just had to be start being paid again. So, we're also seeing that the interest is over 20%, also an all-time high for credit card debt. So now we've had this higher inflation, we have issues, and people are looking, they're wondering, like, where do I go? What do I do? I'm just trying to make my ends meet. Higher interest, higher inflation has hurt the average consumer. And so credit card debt is rising. And this is typically problematic. And we do see this. You see, somebody mentioned on the YouTube channel just a minute ago, recession clouds are building. This is certainly one that, advocates saying, hey, anytime we have debt, we're just taking from further consumption in the future.
Right. And, I sent you an article earlier, I think on Monday, talking about this new
thing you sent. I don't know.
Okay. So anyway, I sent you an article. But to your point, though, millennials are now starting this new thing called it's actually Gen Zers. It's not millennials, but Gen Z are starting this new trend called soft saving, which is, they're living for the moment now, and they're not even worrying about retirement now. It's just like, well, if I get to retire, great. If not, fine. That's a very short-sighted decision, for instant gratification. But we're seeing this across the board, and particularly this article is a good article about is it a good idea to borrow from your 401k plan, because you see that demand for 401k loans really ramp up when you're heading into a recession.
That's right? Well, and so people begin to think, okay, well, how can I better pay for this credit card debt? Or I'm, that soft saving, which is really not saving at all for the most part. And, we talked about this a couple months ago. Right. There's an article out of, I think it was Argentina, and, their inflation has been rampant. And they went and surveyed people on the street, and they said, well, what are you doing? They said, well, listen, we've been locked up. We've got, it's that YOLO mentality that was only confined to the really young generations. Now is kind of everybody. They're like, look, we're going to go out. We're going to go to nice restaurants. We're going to eat. We don't know when we're going to have something happen again. And you know what? We'll figure it out down the road, which means they won't figure it out. They're going to be waiting on somebody to bail them out, unfortunately. And that's the problem with this soft saving. So with 401ks, you can take you can take, if your plan allows it, a loan against it. But here's the problem. And everybody says, well, I'm paying myself back. Well, that's right. You're paying yourself back. But you should be paying yourself back in other ways. You should be cutting expenses. We should be looking at this in other terms. And so
can I interrupt you real quick? Because it's a very important point, right? This is, some people that say this is they go, I'm going to borrow from my 401k plan. Hey, I'm just paying myself back. The problem is you're paying yourself back with after-tax dollars. So when you start making your 401k loan payment, so when you make your 401k contribution, right, that's part of your pre-tax withdrawal, assuming it's a regular 401k plan and not a Roth. But if you pay yourself back, if you I'm going to pay off that loan, it's with after-tax dollars. So you actually get a double tax whammy doing that. So anyway, keep going. Keep going.
So the problem is that you can typically take up to 50% of your balance in the form of a loan. You have to pay that back. Generally, the time frame is within a 5-year period. Now, there may be other parameters within the policy. Now, there's typically most plans only allow up to $50,000 for a distribution. And that's just on average. Some plans don't allow you to do it all from a withdrawal perspective. So you do have to be cautious here. Now, if you're thinking about leaving your job, here's a big negative. If you don't pay that back by the time you file your tax return, all of that loan becomes taxable. If you're under 59.5, you also have a penalty. So
not to mention if you get fired.
Well, I mean, that's if you're gone, right? So now you've got to come up with this cash to pay it back, or you're going to have a huge tax bill. And the other caveat to that is that you're not going to be able to put these funds back into that retirement account. It's just going to be taxable with whatever you've done with it. So, you lose some of that tax deferral, or, which is, I think, a big deal. Now, there's a lot of other options. I mean, here's one we just kind of talked about. What if you have debt? Why are people taking this in general? They're taking this because they've got other issues. Maybe they've got credit card balances that have gone up substantially. They say, well, listen, I can pay this. And generally it's at prime rate, which is currently 8.5%, plus 1, maybe 2%. So maybe you're at 10.5. And so you say, well, look, this is way better than what I have on this credit card balance. Well, that credit card balance, you're paying interest only. The other ones, you're not. And I don't advocate for that either. What I would suggest we need to take a pretty deep dive into what your expenses look like and see where we can cut. And maybe that's not the case. I mean, we hear from people all the time say, listen, we are just living paycheck to paycheck. We've got to find a way to decrease our expenses. But you may find out that loan payment is actually more than what you're paying on that credit card debt. And so you got to be cautious here. But I think another thing you could do is, what if you went out and found a balance transfer, a credit card that allow you a 0% balance transfer for 12 or 18 months, maybe 24 months if you're really lucky, and play the game where you say, hey, I'm going to move it from here. I'll transfer to a new credit card. Make sure you're always making your payments. And then you get that 0%. So now your funds, your payments are actually going towards paying down that credit card instead of just having that interest paid or continue to build. That, I think, is a game that's not played often enough, Lance, because I think it's difficult to do. If we don't do it early enough and we're seeing more stringent lending policies, you may not be able to do it.
Yep.
If you've got bad credit, it may be really difficult for you to go set up a new one and get that 0%. But there's other ways to go about this, and I think that's one. I am not a fan of taking from any retirement accounts unless you absolutely have to.
Well, yeah, look, honestly, I don't think they should allow it. Because, look, I mean,
I agree.
And here's why I know that kind of sounds cruel. It's like, well, it's my money. I should be able to get access to it. For a large chunk of Americans, like 80% of Americans, we talk about the financial situation of most Americans, the 401k plan is all they have saved up for retirement. There is no outside savings.
Well, that's right.
And there's no other, and so they take money out of that, and now they've got nothing saved up for retirement.
Well, I don't like the ability to take for first-time home buying. I don't like all the hardship withdrawals on most of these.
Yeah, no,
because it doesn't incentivize us to save money on the sidelines. And so there's many times when somebody's starting off, we say, hey, let's build that emergency funds. Now, I want you to contribute to the 401k and get your match. We don't want to leave any money on the table. But let's build up that emergency fund first and then go back to that, where you hear a lot of these planners say, oh, no, it's got to be retirement. Well, if you have nothing over here and something does happen,
hey, you're really screwed.
Yeah, that's the only place you have to go. And so I think you're doing yourself a disservice if you don't have a hierarchy of savings. You're not planting those seeds for growth in the future and also for protection. And so that's the biggest problem I think we have, is that we have this mindset that we have to fund this retirement. But if that's all we have and we have hard times, that's the only place we can go. And then that's where you get dinged in other ways. You take the loan out, you get fired, you leave your job. Though that full balance of that loan is now taxable, plus potentially penalized if you're under 59.5. So there's a lot of moving parts here. But the best thing you can do is pay yourself first, put those funds aside, emergency funds, understand where you're getting matches, go to that next, go back to the savings. And then from there, as you continue to create these good habits, start maxing it out.
Hey,
put as much aside as you can.
You know what's a really good habit to start is before you charge something on a credit card.
Don't do it.
Yeah, well, just say,
wait.
If you can't afford to pay for it in cash, do you really need it?
No, that's true. We have a rule in our house that if we have anything over a certain dollar amount, you wait. You have to wait a week.
Do you really need it?
If you really need it, I find many times we do not need what we think we need.
I had to buy something yesterday I really needed because I broke my wife's pepper grinder. I had to order one from Amazon, have it express shipped.
Like it was like, you can have this between 4 and 8 a.m. You're like, yes, please.
Yeah, and it got there just in the nick of time before she got home. So
there are times of need, okay?
Yeah, that was a need.
That's where you're cracking the glass.
That's called
self-preservation.
Exactly. Yeah. That was self-preservation for that pepper grinder. Anyway, all right, be right back after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Bond math is confusing. It's like my wife's girl math. She's convinced that if she buys something at 50% off, she made $50.
The Real Investment Show podcast.
She's now coming up with things about guy math. Every time I buy a new gadget at the house, she's like, guy math. I'm like, hey, yeah, but I save money because I don't have to work as hard. My time is worth money, so I'm saving money if I buy something that reduces my workload at home.
At realinvestmentadvice.com.
Guy math.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
I just want to wrap up this conversation on this, should you take a 401k plan loan? And the answer is no, you shouldn't. I thought this was interesting. Studies have shown that 86% of individuals who have an outstanding loan when they leave their employer for a new job wind up defaulting on their loan. The defaulted balance becomes subject to state and federal taxes and possible state and federal early withdrawal penalties. Studies also indicate that participants under 30 who experience a loan default, which is treated as a hardship withdrawal for tax purposes, end up reducing their financial retirement balance by an average of 20%. So, yeah, don't do it. Just leave it alone. And first of all, and lastly, just Danny, if you take money out of your 401k plan, you have less money growing for you.
No, that's right. And you make a good point on paying it back with after-tax dollars. I mean, that's another caveat that I don't think most people realize. So, yeah, there's a lot of cons with this. I don't see really any pros unless it's just you're in dire straits. You have to have the funds. So I would highly, recommend not doing that. I don't recommend anything on this show, but I would say do not, do not do that. I mean, if you can avoid it, just do it. I mean, I know life's hard. I know things happen. But if you can start putting those other measures in place, hopefully you won't have to get to that point.
Yeah. Well, again, this is why we talk about having an emergency fund, having 6 months worth of salary saved up in the bank. But but again, if you're in the soft saving mode, you're not going to have that 6 months worth of emergency savings. And I'm actually writing an update to an article that I wrote back in 2018, 2019 on the FIRE movement. Remember that whole movement that was going around? Financial independence, to retire early. It went up in flames. And we've gone from FIRE, which was everybody was being super frugal. They were saving up a couple $100,000 and then investing it in the market because the markets were generating 8, 9, 10, 11% a year. living on the interest, getting in their van down by the ocean and, living the life. And we said then that wasn't going to work out well as soon as you had a big market downturn. Well, it happened.
Here we go.
And now we're into soft saving mode, which is, well, that didn't work, so I'm just not going to save it all. We can do a happy medium, right? You can save a little bit and, grow your money and plan for retirement.
Well, and I feel sorry for those people in the sense that, I know they had to be extremely frustrated. I think the average investor is frustrated with these markets as far as how they've been over the last 2 years. But even going back further than that, we talked about, how it's been a choppy time over the last 4 or 5 years in the sense that you get a good year, you get a bad year, you get just a ho-hum year. And I think that, right now it is difficult. But I do see, and I think you agree, you see a lot of opportunity out there still yet, in spite of what is going on. There's some areas we favor or like maybe more than others, but we also need to play the trends. And I think that's difficult for most with so much information out there.
Well, and it's been really tough this year too, because again, outside of just a handful of stocks, the market really hasn't done much.
Yeah.
Small cap, mid caps haven't worked. Bonds haven't worked. Gold is basically flat over the last year. It hasn't really gone anywhere. So, it really doesn't matter where you had money. Outside of 7-10 stocks, the market really hasn't done a whole lot.
Yeah, market breadth was a little bit better the last week or so. Yesterday was pretty poor.
Yeah. And
look at the heat map,
we're seeing that money just go back into Microsoft, Apple, Google. Yesterday that was a kind of a good point of that. But anyway, this is something that kind of leads us to our next topic anyway, which is why Warren Buffett has done more to educate investors than any other corporate executive. I thought this was interesting. Warren Buffett regularly comes out and tells individuals like, oh, just buy an index fund. You can't manage your money. The best thing you can do is just buy an index fund and, just keep dollar cost averaging into it. That's the best you're going to do over time.
Which is always so funny to me that that's what he preaches, because he has done the exact opposite from that, right? The guy does his homework, understands fundamentals extremely well, understands business dynamics, and that's how he's made his living.
Yeah.
But
I think what he's saying is, I think it's a two-faced statement. And this point is like, he's really saying you're too stupid to manage money. So just buy an index because that's the best you're going to do, because you don't know how to do, you don't know how to buy fundamentals, and you don't know how to hold on to things long enough to let them work for you. And he does.
Well, but even that, so fundamentals, I was talking to Mike the other day, and we were talking about some of the things that we were looking at. And he mentioned that, our portfolio management team, you guys are working on a project and looking at fundamentals, and you could go to 3 different independent sources. And these were independent, not like big conglomerate, and all the data was a little bit different.
Right.
So unless you're getting it directly from the source, for many people, it's difficult to do that analysis.
Right.
And a lot of people just don't know how to do it anyways.
Yeah. Well, no, it's a good example of this is earnings, right? Just take the very basic thing of just corporate earnings and forward estimates. If you want earnings estimates on the S&P 500, go to S&P, right? They're the ones that manage the index. So they produce their earnings and estimates for the S&P 500. But then you jump over to FactSet, you get a totally different set of numbers. So which number is right? Which number do you use? And FactSet's data is much more expanded in terms of optimism, I should say, on earnings than even what S&P produces. So, but that's your point is what do you use? There's different measures of valuation. Do you use forward or trailing valuations? Fundamentals, price to sales versus price to book or whatever it is. There's so many different things the average investor, and then we talked a little bit about this yesterday, Danny, on the show, is that technical analysis, you got to understand just some basics of technical analysis if you're going to manage your own portfolio. Just understand what price movement is doing. And you got to understand basic fundamentals of what you're buying. Otherwise, you're just buying stuff that people recommend on TV, or you're buying it because you're looking at a chart and it's going up, but you don't really understand why it's going up.
I feel good about it. I've talked to people that buy something strictly for the dividend.
Yeah.
It's like, wait a second, that's a really high dividend. Why are they paying that high?
Yeah.
Oh, well, it's because it's a great company. I'm like, no.
That's not why.
Wait a second. And there are very good companies that pay nice dividends. But sometimes when we see something that looks a little too good to be true, we have to start thinking, okay, well, wow, it looks really good. It feels really good. Maybe you've been invested in it and it's been fine, but they're paying that higher yield for a specific reason. That's to incentivize us to invest in their fund or their company.
Yeah, but back to Warren Buffett real quick. Every year at the, they have their big conference out in Omaha, Nebraska, and the disciples of Berkshire Hathaway all show up, and and it's kind of a 3-day fest of financial information and galas and other stuff. But again, this is where, and everybody reads the annual report, and everybody parses through the annual report of what's he saying about the economy, what's he saying about the markets. And again, there's we've talked about before, there's a very big difference between the way that Warren Buffett invests and the way that you invest. And the reason he's telling you to just buy an index is because you can't invest the way he does. He buys such a big chunk of the company that he can pick up the phone and call the CEO of the company and say, hey, I don't really like what you're doing. And they're going to listen to him. Yeah. Or he can replace, he owns the whole company, right? So in a lot of cases, Geico is an example, and he puts the person in charge of the company that he wants to run the company his way. You don't get to invest that way.
Well,
right?
he also negotiates deals. I mean, think about when he's bought specific companies. He may negotiate his own dividend.
Correct. When he bailed Goldman Sachs out during the financial crisis, got a 10% preferred.
Yeah, which you and I can't do.
No.
I mean, none of us can do that.
No, but that's what helps when you have $157 billion in cash sitting around. And again, it's interesting too, just talking about that. He's been buying treasury bonds hand over fist. Yeah. Because of the yield on bonds. And again, this is during a whole period where people are going, I don't want to own bonds because interest rates are going up and my bond prices are going down. Why do I own this? You don't care about that stuff. You buy it for the yield and the safety, and that's what. And he's got $157 billion in cash, and that's what he's doing. So this is what we talked about earlier. You got to be careful of narratives. These short-term narratives you hear in the markets will really get you off track of your long-term financial game. What happens in 12 months is irrelevant. What happens in 24 months is irrelevant to your long-term portfolio structure and what you're trying to do. When Warren Buffett buys something, he has no time horizon. He says, look, I'll own this company for the next 100 years. He won't be around 100 years. The company will be, and Berkshire Hathaway will be. And so he has a very long-term time horizon on his investments. And the problem for us as mere mortals is that our whole time horizon now exists between January 1st and December 31st. And if I'm not doing what I need to do, I have to make big changes in my portfolio and change everything in order to try to get better performance. But that doesn't work. Study after study after study shows that the average investor underperforms the markets over the long term because they're constantly changing everything in their portfolio all the time.
Yeah, and I think that it goes to a bigger change. I mean, so we are active money managers in the sense that we more have a buy, hold, monitor, sell type of strategy. But many people just rip the Band-Aid off and say, whoa, I'm getting out. I'm getting back in. I'm getting out.
No.
And
usually at the top, usually at the bottom, usually at the top.
Well, it's emotional. I mean, I can't tell you how many people I've visited with, and especially husband and wife, and a lot of times they'll walk out of the office, or they'll be like, the husband will walk away maybe on a Zoom, and the wife says, "Hey, he's never made any money." Like, what do you mean? Like, you guys have been super successful. Like, no, he's done great in that, but never made any money in the markets. So, okay, well, you start talking about it. And then they inevitably tell you the same thing. And they say, listen, I have bad timing. I've just got bad timing. I invest and the market goes down. I'm like, okay, well, let's take it slow. Here's how we start to move into markets. But if the market inevitably goes down, they usually say, whoa, I got to get to cash, or let's go buy something completely separate. And then they do that, and then the market eventually turns. And so you can't just have this all or nothing strategy where you're all the way in, all the way out, and you get whipsawed around, and that is extremely problematic for long-term returns. You hear that old saying, it's time in the market, not timing the market. Mm-hmm. There is some truth to that to some extent, but for the most part, you've got to be cautious. And you talked about long-term returns. Not everybody has that time horizon. Yeah, we talk about the lost decade, 2000. If you invest in the S&P 500, did not take any distributions. How long did it take you to get back to even?
17 years.
Yeah. So most people can't afford that, especially if we're in retirement and taking distributions. So you need to find some place you can mitigate risk. You can have a strategy, a discipline, and then still participate to the upside, I think is key. And that's one thing that Warren Buffett did mention. Yep. Or this article did.
Absolutely. All right, quick break, come back. Get ready to wrap up the show with Danny Ratliff. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
All right, Dow futures kind of pointing up now this morning. We were down a little bit this morning. Dow's now pointing up here a little bit. NASDAQ futures are flat. So, again, this market's had a very big run. We've had the longest, and this is such a dichotomy, right? Because just over the last couple of weeks, Danny's been here, and we've been talking about the pressure on the markets, and everybody's very bearish on the markets, and the bear market's back, and we kept saying, hey, look, market's super oversold here. Be careful. We've got seasonal tendencies coming up that tend to occur, and now you've had the longest stretch of back-to-back gains in the market since 2021. So things can change very fast in the markets, and they have, and now everybody's getting bullish again. Right? So this is why I was saying, we talked a lot yesterday about narratives on the show. This is why you've got to be so very careful. If you're watching some guy on YouTube somewhere, like some morning radio show, two guys, you got to be careful who you're listening to, right? And because, it's very easy to sell a narrative. Doom and gloom sells a lot. And if I want, especially if I'm trying to, sell gold or something like that, the gloomier and the doomier I am, the better it does for gold. But again, this is why you could be very careful. We talked about opportunity cost by borrowing, take money out of your 401k plan. You have less money working for you in the markets long term. This is why it's important to be careful about narratives because things can change. Now, I'm not saying, I haven't been saying that we're set up for a new bull market and everything's fine. What we've been talking about is this market was getting very oversold, extremely negative. Biases were very bearish, and that's a great setup for a counter trend rally in the markets. And that's what we've had here. We just had a nice reflexive rally. Again, use this to kind of rebalance risk in your portfolio. Mike and I were doing that on Monday. We reduced Apple because Apple can't grow earnings. We still own part of the company. We've owned Apple for a long time. We're going to continue to own Apple for a long time because of the passive index flows that occur into the top 10 stocks of the S&P 500. So we'll continue to own it. But we've reduced that holding because they can't grow earnings, right? They can't grow revenue. They don't have a product that is going to be the next big game changer for them yet. Now they may, right? They may come up with VR or whatever it is, and they'll dominate that space. And don't put it past Apple. Apple's proven that over and over and over again. But for right now, they've had a real tough time growing earnings over the last year, and have really failed to provide that product that's going to be the next game changer for them. So again, reducing that holding and then overweighting Microsoft and Google, which are growing earnings at double-digit paces. So that's the things that you can be doing in your portfolio right now to kind of get you in a better position going forward. And again, as we get into next year, I have no idea what the market's going to do next year. It could be a banner year next year. It could be another sloppy trading year next year. I don't know. There's a lot of risk in the markets, from recession risk to credit risk to financial risk. There's also the possibility that everything's fine. And I just don't have, nobody does, by the way, not just me. Nobody knows what's going to happen 6 months from now, much less 2 months from now.
Well, and if somebody's so adamant about knowing exactly what's going to happen, be cautious. And also, you mentioned on like where you get information from. I think that, we get sucked into a vacuum with social media with all these different information. It's kind of that echo chamber. And, if you're watching one specific area that's always doom and gloom, well, they're probably always going to be doom and gloom. Find somebody who has a different narrative, understand both sides of the argument, and then make an informed decision from there. I think that's an important part that many people lack, is because we really like somebody and we say that's all we're going to listen to, and we don't know exactly what's going to happen. Nobody knows.
Well, and also too, that's a great point, because we talked about this during 2020 when it was all about AMC and GameStop, and we had all these young kids that were fresh out of college, or not even out of college in a lot of cases. They had YouTube channels. They're talking about buying Bitcoin and AMC and GameStop and all this other stuff. They had no idea what's happening in the financial markets, and they're selling product to you, the viewers. And so everybody's watching these guys. They had millions of viewers.
Yep.
And we had couples coming out going, "Hey, we just buy stuff because it's going up, and that's how we make our money." And I posted these videos on our, in articles we wrote. But, one of the kind of the telltale things is when you're listening to somebody, do they manage money, right? Do they have skin in the game? Because if they're just out there talking and they're not actually saying things, but they don't actually manage other people's money or have an investment company, whatever,
or have experience,
well, you would have experience if you're managing other people's money. That's the point.
Well, but
right?
if you're just brand new at doing this.
Right.
I think it's like we get people all the time that ask, hey, how old are you? Have you been through a recession? What are you doing? And I think that's important.
Yeah, it is.
And having somebody that understands and has seen that and seen people with struggles in hard economic times, and then understanding how financial planning, not only that, but the investment management kind of works together. And it's really, I think, is a function of how we work today, is because of the experiences we've had in the past.
Right. And no, exactly. That's my point, right? Make sure there's credibility behind the guy that's. Is he telling you stuff just to get views so he gets paid by YouTube for advertising?
Well, that's the problem. More people on YouTube get paid for doing YouTube than actually what they get paid to talk about.
That's my point.
That's the problem.
That's my point. So just be careful of who you're getting. My point is ultimately just be careful who you're getting information from, right? And don't listen to some guy doing the radio show every day.
Yeah, look it up. I'll have a YouTube channel tomorrow, guys. Okay? Do you get paid for that?
No. Yeah, we never figured out how to get monetized for ever doing this every day
whatever.
either. So
PSA.
Exactly. That's all it is. So anyway, getting ready to kind of wrap up the show this morning. Dan, anything else that we need to kind of touch on?
No, I think that, obviously, we talked a little bit about 401k withdrawals or / loans. I think it's important to understand that's not the best option. Credit card debt, obviously at a high, that's concerning, especially in the economic environment that we are in. Alan Goolsbee, Fed president of the and CEO of the Chicago Fed, just said, hey, we may have a golden path where inflation is down, jobs don't get impacted too much, and we get that soft landing.
And it's possible.
It is.
And because we talked about this yesterday, is that, we laid off all those people, we laid off 50% of the workforce during 2020. All we've done is hire those people back. Full-time employment as a percentage of the working age population is actually a little bit lower than it was in 2019. So we may not have a big we may have a recession without having we may have a fully employed recession, right? It would be kind of weird for that to happen, but because of what we did in 2020, it's kind of messed up we don't have a lot
changed it. This time is different.
Yeah, we don't have a lot of overemployment. We didn't have a period where people were just hiring everybody and we got overstaffed, and now you have a big reduction for recession. We kind of just hired everybody back. We laid off, and companies are mostly running pretty lean and mean.
Yeah, but this time is different until it's not.
Of course.
And so, I mean, I don't know how you fix the credit problem. I don't know how you fix with higher interest rates. How do you fix that? Unless you see massive wage growth, which therefore will cause more inflation, which therefore will cause higher interest rates, which puts us in the problem.
But you need a massive increase in employment and need much stronger economic growth. And where's that coming from?
Correct. Not with this demographic either.
Correct. So, I mean, this is the problem, and this is the problem with people that tell you they know what's going to happen next year, is that there's so many things that are different this time. And that, look, you always got to be careful. This time is different, right? This time is always different than the last time. No two times are ever the same. Outcomes are often the same, right? But no two times are the same. And this time is different because of 2020 and 2021 and what we did with stimulus and, the Inflation Reduction Act and CHIPS Act and these trillions of dollars that we've spent have certainly changed the underlying dynamic. And if anybody tells you they know that the world's going to crash next year and they know that this is going to happen for sure, take it with a grain of salt because nobody knows.
So we were talking a little bit about Warren Buffett, and so he does one thing that I admire, I think is good, is that he does say in his newsletter, or not his newsletter, his annual letter, he writes down his mistakes. And so this states, as if he later thinks he overpaid for an acquisition, he admits it and shares the lesson learned. In his 2014 letter, for example, Buffett wrote that among Berkshire's portfolio of subsidiary companies, there were some poor performers. This was the result of some serious mistakes I made in my job of capital allocation. I was not misled. I was simply wrong in my evaluation of the economic dynamics of the company or the industry in which it operates. And I think this is a prime example because, we talk about many different things. I mean, we looked at numbers for, bonds, for example.
Yep.
And everything would suggest that this shouldn't go any further. Rates shouldn't go any further. Then what would happen? We'd have another stimulus package. We'd have something would be extended. Things that are out of the control of the current market situation or economic environment. And that's what makes things so difficult when we're talking about managing money. But yet you can't have, all in on something. And that's my point earlier, is that if you're doing so and you minimize those mistakes, where they're not humongous in the sense that it is all of everything, then I think you're going to be okay. But you got to understand that that's why we don't get all in and all out either.
Yeah, that's absolutely right. And again, this is why it's always important to understand about volatility and how much volatility you're taking in your portfolio. Are you trying to chase market returns or are you trying to grow money over time? And those are two very different things. And it's okay to chase returns if your goal is to beat the market every year. Nothing wrong with that. I saw a TikTok the other day talking about if you can you take your money and you invest it, you make 2% a day trading for 280 days a year, which is when the market's open. So every day you just make 2% on your money and you compound that. You start with just $1,000, and in 2 years you'll have $15 million in your bank account.
Wait a second.
Just 2%
2% a day.
Make 2% every day and compound it. Never take any money out. That's all you got to do. $15 million in 2 years.
What am I doing? Why am I working this hard?
I don't know. Just go make 2% a day. It's easy. Apparently.
Right. Only buy what goes up.
Yeah, exactly. So, he's on TikTok, by the way. So if you want to go follow him, you can. And I'm sure he'd appreciate the advertising revenue from you. Just make 2% a day. No big deal.
Perfect.
All right. That wraps up the show for today. Danny, thanks so much. We'll be back tomorrow with Michael Leibowitz. Had a lot of Fed speakers this week. So we'll get into some of the stuff that they said and what that potentially implies for yields and the economy and markets heading into the end of the year. We'll see you then on the next edition of the Real Investment Show tomorrow. Be sure and get by the website today. Michael Leibowitz's new article is out now on the website, realinvestmentadvice.com. See you tomorrow.